Welcome to The Unconventional Investor, where strategy, mindset, and money come together to build lasting wealth beyond the numbers. I'm your host, Michelle Moses. Hello, everyone, and thank you so much for tuning in. I am Michelle Moses, your host, and it is going to be another solo show today. I've been doing a lot of these lately. And today I want to talk about giving in a way that fits your life and your taxes and your values, because I think a lot of this, where taxes are kind of where the tire meets the road, right? And my first episode, I'm doing a 3-part series about charitable giving. The first part was about the Arizona tax credits. And if you aren't in Arizona, then you probably aren't going to listen to that one. But the second one was with Tessa Wardzinski, and we talked about ways to make giving automatic and a part of your life. And we kind of touched on why you would give and the benefits that society and that you get from giving. And then this is going to be the third one, where I'm talking about how this giving affects your taxes and different ways that you could give so that it could be a larger deduction on your taxes. And I think this is needed because for a long time, the laws were the same, and then they changed last year with the big, beautiful bill. And so I want to go over what those changes were. And before I start, I really just want to encourage people to give. If you can't give monetarily, maybe you could give of your time. There's a lot of organizations that are really needing support right now. And anything that you can give, I think, would be helpful. So let's dive into the simplest part of taxes when you're donating your money. And used to be that, you would submit your taxes and then you talk to your CPA, and then the $200 or $250 could be automatically taken off. And if it was more than that, they would ask if you had receipts. And then you could, I gave $2,500, I gave $5,000, whatever it was. Well, now that is limited to $1,000 for single and $2,000 for married. So if you do what most people do on their taxes, which means you add up all of your income, you're subtracting out your 401k deduction, and then you get your adjusted gross income. And then what it's called that you take a standard deduction. And a standard deduction is really kind of there so that you don't have to itemize every single little thing that you spend money on, to be like, hey, I just did $50 here and $500 there, and then I got to keep track of all of this. They just do the standard deduction so that you can kind of roll it all up into one. And most of the time, the standard deduction is higher than what you would have actually given. Now, I don't make the rules up. I know that it's very complicated, and to me, it's kind of weird, but this is what it is, right? Okay, so if you're single, your standard deduction is $16,100. If you're married, your standard deduction is $32,200. And so being a married person, right, I'd have to spend a lot to get over that $32,000. Right. So I usually would take the standard deduction, which means we are limited to $2,000 off on our taxes. So let's pretend that I give $5,000 away next year or this year or whatever. And then I also take the standard deduction of $32,200. Even though I gave $5,000, I'm only going to be able to write off $2,000 of that. So you need to be aware, and you're going to want to check with your CPA or tax preparer before you give a lot of money. Can you write this off with the way that you're doing your taxes? And what are some creative ways that you can do your taxes so that you can write it off? And that's what I kind of want to go over today. Or there's different ways that you could get over this $2,000 threshold if you wanted to. I don't know that a lot of people could, but I want to go over different ways that you might be able to help too. So first, I want to start off with something that's fairly easy, and that is listing your charity as the beneficiary of your IRAs, of your annuity, of your life insurance, anything where you have a beneficiary listed. You could list a charity. And if you do this, you don't have to list the whole thing. I mean, you could give them 10%, you could give them 5%, whatever. It could just be a portion of it. It doesn't need to be the whole thing. So even if you were leaving all of it to your kids, you could leave it all to your kids and then just leave 5 or 10% to, the Humane Society or whatever charity happens to pull your heartstrings. That is the easiest way to do it. You can even do it with your car and your house. You could have kind of like transfer on death. They're called different things, but transfer on death, title deed on your house and one on your car, so that when you die, those automatically go to charity. So there are different ways that you can do things. I would not recommend that you split up the car into different, but you get my drift. So there's a lot of ways to do things. Now, if you were to try to go over the $32,000, or if you're single, over the $16,000 threshold of the standard deduction, you could what's called itemize. And so what itemize means is that you are going to submit all of your expenses to your tax preparer or CPA, and then all of those expenses would hopefully be more than $16,000, right? And if they are, then you can write off everything that you give away. So if you give away $10,000 in cash, plus you had other expenses, then you could probably write off all of that money that you gave away. There's a caveat in there, is that if you were to itemize like that, you can't write off the first 0.5% of your adjusted gross income. So for an example, if your adjusted gross income was $175,000 a year, you could not write off the first $875. I don't think that's a big deal if you're giving away $5,000 or $10,000, but everybody wants their tax deductions. But just so you know that if you do itemize, there is a 0.5%, what they're calling floor, that you cannot write off. And so now I'm going to kind of move into some different ways that you could give besides just cash or listing a charity as a beneficiary designation. So if you're listing as the beneficiary designation, what's going to happen is that once you pass away, they will contact the charity, and then the charity can decide whether they're going to keep those securities as is, or if they're going to liquidate it, whatever they're going to do with it. But while you're alive, if you wanted to give away some of the money, what you could do is you could give away the actual security that you have. So let's say you have a stock that your grandfather gave you when you were younger, and it just has a huge gain in it, and you are feeling like you wanted to give it to charity. You could actually gift them that stock and then take it out of your taxable income and then get a deduction for it. Again, there's slight rules that would go into this with your adjusted gross income. So you're going to want to run all of this by your CPA or tax preparer. I'm just trying to give you some ideas that you will want to talk to them about if this is something that you want to do. But that is something that you can do, is gift them the actual appreciated securities and then have that taken, get that deduction out of your taxes, and then you're not realizing the gain. So another thing that you can do too is do what's called a donor advised fund. And this is where you might be able to reach over the threshold of the standard deduction. And that is by lumping maybe 3 or 4 years of donations all in one year. So let's say you wanted to give away $10,000 a year. And so that means, you were going to give $40,000 this year. And so you would be over the $32,200 if you're married threshold, right? And then you have other expenses. So you could do that, and then you could give that $40,000 to this, what's called a donor advised fund. And it's exactly what it means. It's donor. You are the donor, and you are advising them where you want your money to go. And so you put it with these organizations. There's many, many of them around the country, and you basically gift it to them and they manage the money, but you put it into different funds. So it might be a fund for a specific charity that you like. It could be just a pool of charities that all focus on the same thing. So it could be environmental, it could be the arts, it could be children, those sorts of things. You could also set up your own foundation with some of these companies. So if you wanted to gift a lot and you were like, hey, I really want to do this more often, then they could manage like your foundation account for you. And then they could also just have it, you could put it like in your name. And then what happens is that you basically are telling them, this is where I want my money to go for this year, have it go to such and such charity. So it really depends on if you want to change it every single year, or if you want that gift specifically for a specific charity for the lifetime of that investment. Those can get really, there's just like a lot of different levels with the donor advised funds, but I do know a couple different companies in town, and they actually make it kind of fun. And it's, I don't know, giving is really fun, and they make it like a lot of stories, and then you see where your money is going, and it's kind of cool to see. Another way that I don't feel like a lot of people know about is what's called a qualified charitable distribution. And this is for people that qualify for required minimum distributions from their IRAs. So when you reach 73 and a half, you are required to take money out of your IRAs. So any money that has not been taxed yet. Okay. So we call this qualified funds. So your money is not yours until you have been taxed on it. Okay. So your Roth IRA, that's yours. But your regular IRA, your 401k, it is not yours until you pay taxes on it. So what happens is when you turn 73 and a half, the government says you have to take out this amount. And it's a calculation based upon the amount of your IRA at 12/31 of the previous year and your age. So they have a calculator that you work with, and it'll tell you how much you have to take out. So if you took out your required minimum distribution, it counts as income on your taxes, okay? Just like you're out earning it, right? And then if you wanted to give that to charity, it would go from your IRA to your bank, and then you would gift it to charity, which means you would have paperwork and you'd have to claim that income on your taxes, right? And then you would have to be dealing with the rules that I kind of just went over of only being able to give away $1,000 or $2,000 a year. Versus if you have your IRA directly, your RMD, so you have your RMD directly go to the charity, it is called a qualified charitable distribution. And it is not going to hit your taxes. And so you're not going to have all of this, I'm giving this, I'm only doing $1,000 or $2,000. You can actually just give your RMD straight to the charity. And then it's skipping your tax situation. So if you do have a senior in your life that is taking an RMD, that might be a really great way. And they're not needing it. I do have some clients that don't really need it. A lot of people will just move it from their IRA over to their Roth IRA, and then we'll let it grow there. But if somebody was wanting to do something with charity, this might be a great way to do it. And if you have parents that have an RMD, you might want to talk to them about this as this being an option. And the last one that I want to go over is what's called a charitable remainder trust. So this is where you can gift securities. Most of the time, it's when you have some sort of appreciated asset like a house or some stocks that have a huge gain on them and you don't want to realize the gain. So what you can do is you call a lawyer, you can set up a trust, what's called a charitable remainder trust, and then you gift these assets to this trust, and then it comes out as a charitable donation in that year. But then what happens is as you're living, you can live on that income. So a lot of times this happens with like houses and things. So they will donate it to a trust, but then they can live on the income. And then when they pass away, the house or the appreciated securities go to the charity. And so this is very popular with high net worth individuals. I understand that not everybody can do that, but I just wanted to put that out there that is an option of something if you do have something that is highly appreciated and you are not selling it because of the capital gains taxes that you're going to have to pay. So I've gone over what the standard deductions are and how your taxes have changed to the $1,000, $2,000 limits. We have gone over donating appreciated securities, listing the charities as your beneficiary, either 100%, 10%, 5%. You could even do 1% if you wanted to. We've talked about donor advised funds and bunching your yearly contributions together so that maybe you could get over that $32,000 or $16,000 threshold if you're single. We have also talked about qualified charitable distributions for seniors, and that's if you're 73 and a half and required to take your RMD. And then lastly, we talked about charitable remainder trusts. And I think if you're going to be listing any charity and they don't know it, because if you're in a donor advised fund and the charitable remainder trust, a lot of times the organizations know it. But if you're listing an organization as the beneficiary, they're not going to know that. So if you could let the charity know that you were doing that, that would help them plan for their resources, plan their programs. It's obviously better that they know it so that they know that something is coming. And then maybe you could even get more involved and, who knows what would come from it. And I really want to wrap this up by just encouraging people to feel what it feels like to help other people. We are just in a rapid changing environment, you guys, and the way that things have been are just not the way that they're going to be in the future. And that's okay. But we need to change how we're thinking about things, because I feel like as Americans, we've always just been like, yeah, the state will take care of that. The government will take care of that because we've been paying all these taxes. And now that has been cut. And so no one is going to save us but ourselves. And so I think that we need to be stepping up and giving of our time and our resources, or however you are able to do things. Then I say do it, because there is no better feeling than helping someone else. Like there just isn't. Like if someone is in need and you are helping them, there is no greater feeling than helping another human being. And I want to encourage you to connect with that feeling of what that has felt like when you've helped someone else. And that is why we're here, is to be with people and to love people and to be loved by them and to share in these experiences. And so I just really want to encourage you to connect with that feeling that you get from helping others. And I understand that this episode is about taxes and money, but it doesn't necessarily need to be that. And even if it's $5, I mean, you know the story, even when you don't have a lot, if you can just give something, people are really appreciative, and it makes you feel better. It makes them feel better, and it could help someone else. So you guys, thank you for listening. If you do think about it, please leave a review. It helps me reach more people. I am having a lot of fun doing this. So thank you again for tuning in, and I hope you have a wonderful day. Thank you for listening to the Unconventional Investor Podcast. I hope you feel more confident in how you can grow your wealth using the strategies I shared in this episode. If you're ready to take the next step in diversifying your portfolio outside the stock market with alternative investments, head to mefinancial.net/contact us to book a 15-minute consult call with me. Let's discuss how we can work together to achieve your financial goals. Until then, I'll see you on the next episode.